I wanted to build wealth that would grow and be recession resilient. I wasn't too excited about the idea of doubling and tripling my money the next year and the next. I was more reasonable risk-adjusted returns.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today, his name is Patrick Grimes. I'm thankful he's going to be with us for a couple of segments. So I want you to know that up front. So you're not just listening to today, but you'll hear him again tomorrow, diving in depth in some other things that I know you're going to want to know. He's the founder and CEO of investonmainstreet.com, private equity firm that enhances professionals' quality of life by providing tax shielded and inflation hedged passive investments in alternative investments. He's founder CEO also of Passive Investing Mastery, an education platform that I think he and his wife are putting together. And since 2007, has purchased and renovated distressed real estate assets, 600 million plus portfolio included 5,000 multifamily units in emerging markets across Texas and the Southeast. He's also co-authored a book that he's going to mention, obviously, at the end of each segment as well. He's going to tell you how to get that, highlights his story. Right off the bat, you're going to hear how he lost everything. Right? He lost everything in the 2007-8 recession, right? And he's going to come back, out of that, right? And talk about, what did he learn from that? What did he do different? And how you cannot speculate with investing. We've all heard that, but he dives into what that actually means. And don't forget, next segment, he's going to dive into, what does it look like to put a deal together today? What does that mean? And different things about structuring and reserves that are going to be very important to you. Patrick, welcome to the show. I've been doing a little research about you beforehand, and man, you've got a ton of experience I want to dive into. I know you're going to be able to help our listeners today. There's a ton in your background, though, that I want to dive into that I know is going to be beneficial for all of us. And let's do just that. And give us a little more about who Patrick is, a little bit about your background, and then we're going to jump into your experience in real estate and some of the hard knocks as well that I know you've learned and come out of.
Yes, I have. It's all daisies and dandelions. That's what I'm here to tell you today, Whitney.
That's great.
Yeah, it's great to be on your show as well. As I was mentioning before, I've heard about your show now many times. It's kind of that. Well, you haven't been on that show yet? So here I am, finally coming full circle and getting out of my engineering hobbit hole and getting out in front of the world and making it to the pinnacle of Whitney's show today.
That's right. No, grateful grateful for the kind words and glad a number of people recommended it. So, Patrick, why real estate? You're an engineer. It's not easy to become an engineer, right? Then transition to something else, right? What happened there? Why the transition and why real estate?
Yeah, not easy to become an engineer is right. I mean, electromagnetic static physics class was harder than underwriting a multifamily deal, that's for sure. But as a young guy, I was definitely an engineer. And I was building Legos, playing with electronics before I even knew what engineering was. And I started right out of college doing machine design, automation, and robotics. And it was super fun. And even to this day, I love it. And I only stopped doing it entirely a number of years ago. So for a lot of my career, I was doing really cool automated manufacturing cells for Elon and Tesla and Lockheed and Boeing and Johnson & Johnson for medical devices and satellites and all kinds of cool stuff. And it was just, perfect geek heaven. But the seed was planted at the first design firm that I worked for. The founder, Dave Carlberg, great friend of mine, still invests in my deals today. I actually talk about him in a chapter in a book. I'll be happy to give away a copy of that to your listeners at the end here if you'd like. But he gave me some advice, and he said, his only regret was not investing more in real estate sooner. And I was blown away because this is a very successful high-tech guy who's got his own company doing some of the coolest stuff, the most amazing technologies, working with some of the most brilliant companies. And here he is telling me high-tech is volatile and risky. Don't put all of your money into it. What will get you where you want to go in life is real estate. And so that's what planted the seed. And I was eager and excited and immediately did my first real estate deal.
You just jumped right in, huh?
I jumped right in, naive and inexperienced. And this was 2006 and 2007. So I very quickly lost it all.
And what kind of investment was that? Was that a passive investment? Was that a flip? Was that a single family rental? What did you decide to do first?
Well, so as kind of an analyst at heart, I did a bunch of kind of research on what the highest returning deals were. And that invariably in real estate was development, creating something out of nothing. And then if you reel in, to the early stages of development, you have pre-development. So I was like, well, look, if I do this, I can double and triple my money every year. And so I actually got into a pre-development deal. We, bought land. I personally guaranteed the loan, and I wanted to use my money wisely, so I leveraged it as high as I possibly could. I'd like a 90% loan to value, personally guaranteed it to get the best terms I could get. Then went off to the races, paying out of pocket for the loan, hoping that we would get the land ready to go and then a building built in time. And unfortunately, 2008-9 happened, and basically the land lost almost all of its value. All the builders were bankrupt. There was no way out. And I learned what cross-collateralization was. I learned that when you sign on a recourse loan in your own name, they can come after you and everything. And so they're not just going to take the property. They're going to come, and so it took me a couple of years being drug over the coals real bad. I had to hire an attorney, had to do a settlement. The bank did debt forgiveness. They took the property through foreclosure, credit wrecked. I had to pay taxes on the debt forgiveness to the IRS. Like, what? Nobody ever said that. And it took me, 5-6 years of kind of financial and emotional recovery where I was back in high tech, got a master's in engineering, master's in business, started pulling in significant income again. Like many of your listeners, high paid professionals, what do you do? And so I had to do real estate, but how? And that's when I started over again.
So you went back to school after losing everything?
Yeah. So I was always working full time in high tech. And so after I was going to make it big in real estate, and it took me, like quite a few years, just dumping money to get free of this thing. And I knew I couldn't get into real estate immediately because the credit was wrecked. But when I started doing well in high tech, I went and did 2 master's degrees to kind of accelerate that, because I was like, oh yeah, I'm going to make this work one way or another. So I went after it, and it worked. I was doing really well in high tech, but I had to start investing again. And just probably like most of your listeners, they want diversification. And if you look my passive investor guide on my website, since the very first day I started the company, on like slide 5 of it, it has the diversification of the wealthy. And it has that the middle class is about 8% in alternative investments and private equity and real estate, things outside of your 401k IRA plan or your financial plan or index funds. The high income earners have 25%, and the ultra wealthy have 50%. So if I was going to make it out and as a high income earner get to the lifestyle that I needed to get to, I had that voice in my head. I had to get passive income streams that weren't just my job. I had to get inflation hedging. I had to get debt in the right way. I had to start building out streams of income and diversify. And so really the only way to do that was real estate, and I had to get back into it, but in the right way. And so that's what led me back into it.
Nice. I'm surprised, well, I'm not surprised, but very few want to get back in right after they've gone through that, really been raked through the coals, sounds like, right? Losing everything, and they think, man, I'm going to stay away from that. I'm going to go do something else, right? That I know, or I know more about, or maybe it was tech or something like that. But you didn't. It sounded like pretty quickly you still knew that was the path. Is that accurate?
Yeah, well, so I kept listening to podcasts, I kept reading investing books, and I had that voice in my head from my buddy Dave, right? And I read the Purple Book. So there's no escaping. If you really want to make it, you circle back to real estate. You just have to learn how to do it without speculating. You have to, like I was doing. I was hoping, I was gambling. I was taking the big stack and putting it on green and spinning the wheel and hoping, right? But I learned to, that there are things called recession-resilient markets. I learned things about recession-resilient asset classes. I learned about buying existing construction for cash flow and then making repairs to them to create value as opposed to creating something from nothing, right? And I started buying single family homes in Texas, which according to my data was the most recession resilient market, performed incredibly well in prior downturns with diversified employment. And it was working great. I started moonlighting it and doing my job, flying all over for my job, and then building out a single family portfolio in Texas. So that's what got me back to it. It was working, but it was brutal. And I think that's what the glamorized TV shows about, the fix and flip and all that don't tell you, is that if you're a high paid, successful professional, you're using a lot of your energy doing that and trying to fulfill this kind of American dream thing where you're supposed to become a landlord. That's brutal because it takes all your time away from your family, friends, and hobbies, right? So
For sure. And how did you fund that then? You lost everything, right? I mean, you got all that happened or you lost everything, but then, how did you then go forward and fund? It was just you had a JOB then that was able to fund, buying some single family homes, or were you able to start getting debt, or were you funding them completely?
yeah, so it took me 5 or 6 years to get shake off the credit issue, right, from 2009. In that time, I had doubled and tripled down in my engineering career, the high tech space. I doing very well. And then when I got my master's degrees, I left that and went to a new company where I was like at executive level. And so the bonuses were substantial at that time, and I needed a place to invest, and I needed that diversification. And so that it was to a point where I really had to find a way to put that money to work. And invariably, you're going to find your way back to real estate, just investing more of the tortoise instead of the hare, right?
Yeah.
And more humbled. And that's what really got me back in. And it wasn't until that I met my soon-to-be wife, because I mean, I've traveled a lot. I've been through over an eighth of the world's countries. It's been a couple years, a couple gap years traveling through the Middle East, Asia, Southeast Asia, went through Europe. And so I've traveled a lot. But when I met my wife and I was spending all this time on my soon-to-be wife, I had to stop that because I was already, 35 and I hadn't been married yet. I met this wildly amazing girl, but I was not available. And so she was there for my very last single family closing. We did it. It's met the notary at Starbucks. And I said, I'm not doing this anymore. And I have to figure out another way. But after that, she married me and we just had our baby. But that was a while. That was about, 6 years ago, 7 years ago now. But we married in California in Beijing. And it wasn't until after that that I started trading up to partnering into larger assets, getting over the DIY control issues, learning how to take down bigger assets that are lower risk and work with others and raise capital from others so that we could be successful together. And that's what led me down the path of multifamily.
Yeah, our families or time with family can do that often, right? It can change our plans. I was going to ask you, when losing everything, if you were married at the time, or just the dynamic of family and the impact on that, right? If you're losing, when you lose a lot like that, and it sounds like you were not, and so you. It was just you, so it didn't affect maybe the whole, a number of family members. But man, what about? I was thinking though, you said you can't speculate in investing, which we've all heard that. But I wondered, what would you say? You said recession resilient properties, markets. Give us a few thoughts there on that. On the investor listening right now that says, "Well, I know I can't speculate," but what does that mean, Patrick? Give me a couple of things that I can take home today when I'm looking at a deal today that's going to help me not to ensure I'm not speculating, right?
Yeah. Well, and so we can kind of unwrap that. And I love to use the example of how we find distressed assets and distressed properties today and how they got them there and how we can prevent ourselves from getting there. So, for example, there's a lot of individuals who during COVID were buying properties in San Francisco and San Jose, right? Those are areas that traditionally are markets that are not recession resilient. And if you've looked at past data, they have dramatic swings. So you've got to be in areas with diversified employment, and so that have a past history of being able to ride out recessions. And those employment are things like a combination of healthcare and logistics and education, maybe some manufacturing, hospitality, but not overweighted. There are specific industries which tend to have better resilience, and when you compound uh, a location which is recession resilient with a place that is attracting people and jobs, typically they're tax advantaged and landlord friendly, they're legislative friendly locations. Then you end up with, even if there is a downturn, you'll still have an influx of people because you have growth, and that softens the blow. And that's what really happened back in 2009 and 10, and why Houston only almost leveled off before it started going up again. It's because it was decreasing, but it was growing at the same time. You saw the same thing during COVID, where you did have economic impact in the southeastern states and Texas that are landlord friendly and advantageous, but they were growing at a rate that helping to soften the blow, right? And so you stack on those tax advantage landlord friendly. So once you've got your market established and it's got that recession resilience and that growth factor with those indicators, you've got to find the right asset, right? And those assets, and when I say speculating, I mean, if I go into the desert and I say, hey, this is the new Vegas 2.0, I'm going to create a new Vegas in the middle of nowhere, you're essentially wildcatting like an oil and gas. You're just going in the middle of nowhere and just creating something. That's a speculation. In the same way, in development, although there were other developments around, I was taking a piece of land and I was saying, look, I can hope that I can get something built on here. I can hope that I can get this entitled and we can get the roads and the facilities and then we can get something built. That's more of a speculation. If you're buying existing assets, which is what I transferred to, then there was already a pad with sticks up. And there were other pads nearby with sticks up, with houses and roofs and people in them and renting. And so it becomes more of an analyst play when you're looking, okay, here's the income generating ability of the apartments nearby and this one, and I can buy it on day one for cash flow and make measurable improvements to it. That's not a speculation, that's a calculation, right? And so once you find the right kind of assets, which led me to, the 3-bedroom, 2-bath, and then later I transitioned, which I don't think there's anything between above 80 units. There's either 3-bedroom, 2-bath, which is the longest running appreciating asset in real estate, or there's inefficiencies beyond that, and then more inefficiencies until you finally get to on-site property management. You finally get to 80 plus units that can afford that. You get to properties which are large enough to get non-recourse debt, which means the properties are strong income generating businesses. And at that point, you get valued based off of your income. And so it's just much safer bet to be either in one of those two, and it's inefficient in between in my mind. So I found recession resilient assets to be those existing construction, which are traditionally 20 to 50 years old, when placed in these markets. But even if you've done all that right, you've got the right kind of asset that you're buying that can be improved, and it's been around for a while and it hasn't been repaired, but you can see the nearby properties that are renting for more that can be repaired. That doesn't mean you're home free. That means you've found probably a good deal, but if you don't structure it in the right way, if you don't build an economic foundation for it to weather the storms of recessions, then you're going to become one of the many distressed operators that exist today. And so, like I did, you could get really high recourse, really high variable debt on that. And a lot of people did and are struggling now to how we built a recession resilient portfolio is instead of leveraging it to the hilt, we did very low leverage. We put high down payments down. We looked in the past and said, hey, during recessions, what did the vacancies drop to? And so our properties need to cash flow, not only when we get to on day one, but we need to cash flow so much so that we can still pay our bills if another recession happens. So you're going to throttle back your returns a little bit because you're going to put a lot down, right? You guys also have to have a foundation of a loan that's not variable. You need to have the ability to cash flow for the long haul, even if interest rates go up. And right now there's $1.5 trillion in commercial bank debt coming due at a time when interest rates have skyrocketed. So what does that mean? Some people were very aggressive, like I was in the first downturn, which I'm not anymore. And they said, hey, I'm just going to get the highest leverage I can. And I'm not going to get fixed debt because they want me to put too much down. I'm going to get variable debt. As the interest rates grew, it sucked all their cash flow.
Yeah.
So they went upside down. So that's happening all over the place. Now, some people bought an interest rate cap, and we did that on a couple properties too. Put enough down to cash flow when your vacancy increases to what it has in past recessions. But now you have to put enough cash flow to make up for the fact that if interest rates go up, your interest rate payment is going to increase with it until you reach your interest rate cap, right?
Right.
So you have to put enough down for that. And then you have to raise even more money to pay for the interest rate cap. So the economics of a deal that can weather the recessionary storm is different. People that are putting huge returns on deals, some of them are just transferring that risk back to their investors. Some that are projecting much lower returns are really looking at that capital preservation and long-term wealth. And that's why I believe it takes a longer period of time to build the right kind of investors to build a better, more healthy wealth building portfolio over a longer period of time. So there's a number of other factors we go into, but those are some for you.
Yeah, you just talked about building the right kind of investors and for a healthy portfolio. I was just going to make a note. I want the listeners to know that we're going to do another segment with Patrick. And so the next show, you'll hear him talking about leaning into the recession and putting deals together today and what that looks like. He's mentioned a number of things already, but we'll go a little more depth maybe. And I want to hear a little more about the building the right kind of investor base, right? For a healthy network or a healthy business like you're talking about. But before we end this segment, I wanted to, we're going to get back to really the discussion you're talking about right now, I think in the next segment, even more so. But before we do, I wanted to ask you, you mentioned about partnering, and it sounded like maybe that's when you really took off in the commercial real estate space. Is that accurate?
Yeah, absolutely.
Yeah, I get questions often about partnering and how we've partnered and what that did for us or for me. But when did the the aha moment come, right? The realization that, okay, I can't do all this myself. I do have to partner with some people maybe that have other skill sets or whatever that is. What kind of brought that about? Because that's I've been combated by this. People want to know, well, I just I want to do it all myself. I'll do a better job or whatever. And it's such a limiting belief, I think, now. But one time I believed the same thing, I think. But what about you? How did you get past that? How did you know it was the right partnership? Some of those things.
Yeah, I think there's a combination of things that kind of are where we are in kind of how we're being raised in this country with the idea that the money is not, we put it all, the 401k and IRA, or we put it away to a financial planner. And somehow that's the acceptable automatic way where we can be passive investors in that way. But everything else is dangerous and everything else is scary and risky. And even though you'll give away your money and never even look at it or touch it to these individuals, right? When it comes to anything else like buying real estate, we want to maintain control. And that's not uncommon. And especially if you're a doctor or a dentist or attorney, you're used to being very, very good, or engineer like I was, whatever it is you do, you're used to being the smartest person in the room. You figured out some wildly difficult things. You're like, I can do this too. But you have 8,000 hours of experience making you brilliant at what you do. Do you really want to put 8,000 hours into something else to be as good at that? No, you don't. Why? Because you go to the dentist to get your teeth cleaned. You go to the mechanic to get your car fixed, right? You're already partnering. But when it's something about what I was going through at the time, having lost it all once, is something that a lot of my investors relate to. And I wanted to maintain that control. I wanted to use all of my own money, and I wanted to make sure that everything went. But what that meant was Mr. Thinking that I can do everything, was doing a bunch of things I didn't want to do with my life. I didn't want to have all the jobs. I didn't want to be chasing property managers and underwriting and dealing with tenants, toilets, and trash. I wanted to be investing in what I loved, which was the engineering, and what I loved was the kite surfing and backpacking and traveling and all the things that I was doing, and marrying my wife. And so it took that breaking point of realizing that, hey, there's other people doing this better with me. If I partnered with them, I could get some time back and marry my wife. And that's when I said, look, I'm gonna learn how to do this differently than a partner. And then it worked. But 2.5 years from the time that I closed on my last single family home to the time that I closed on our first 86 unit deal. So there was a long period of warm up to new industries, learning how to do larger acquisitions, learning all the roles, as Whitney talked about, underwriting, asset management, capital raising, all the different aspects, the new debt products, and finding my path the exact way. And then I met dozens of people, talked to at least a dozen about possibly working together. And then when it came down to it, very few were aligned in the way that I was, where I was very patient with returns. And I wanted to build wealth that would grow and be recession resilient. I wasn't too excited about the idea of doubling and tripling my money the next year and the next. I was more reasonable, risk-adjusted returns. And there aren't that many people out there that are like that. And I was able to finally find some, and it showed up in the underwriting, it showed up in how the properties were managed, and I was able to track the track record and look at the properties, finally able to find some like-minded individuals. And then I just brought value to them. I did everything I possibly do until one day brought a ton of deals to the table. And one day they were like, hey, let's work on one together. And that's how I got into the space.
Yeah, a couple of things you mentioned there I wanted to highlight. You said 2.5 years from the last single family to the first multifamily deal. In the moment, I have a similar time frame actually, but in the moment, man, it just seems like it's taken forever, right? In the grand scheme of things, it's actually pretty fast, right? To be able to move forward on a project, I feel like that large. I first started learning about this, I never imagined being able to buy a 100-unit property, and then I met guys doing it who hadn't been in the business very long. It kind of opened my eyes to the possibilities. But still, it came through partnerships, right? Where I love the thought too behind, you put 10,000 hours in something to become really good at it. You're probably not going to want to spend the time doing that on every piece of this business, right? And you want the people on your team who have done that, right? You want that level of skill set on your team, no doubt about it. So I like the thought behind that. And then even you mentioned very few were aligned with where you were at, and you related that maybe to the conservative nature maybe you had to, or expectation of returns, right? But anything else there that you would highlight? Because I get this question often about partnerships and how did you know it was a good partnership, or to move forward? Or I was asked many times and turned down many people to partner before I actually started partnering. But was there anything else for you that said, what, I'm going to pass this partnership, or no, I know this is a good one because of these things?
Yeah, I actually did a talk in Dallas recently on I don't know what they called it, the critical conversations in partnering. And I kind of told a bunch of stories. But it's funny that your gap was similar to mine. But you know what? Anytime you really want to make a leap forward, you got to take a step back. When I did, it took me about that same amount of time to get through my master's degree, but on the other side of it, my income doubled, right? And as you probably did, when we did the gap, our wealth accelerated, probably quadrupled, right? Like mine. And so, but in the trenches and in the battle, I vet partnerships through hard work. And what I found was so interesting is I'm in Waikiki right now, and we actually moved to Waikiki, Hawaii for 2 years during COVID. We relocated when our son was born, but we quickly realized that we could still spend a lot of time in Hawaii. So I'm here for 3 months. And so I was sitting here right here when I would get the phone calls and, oh, we've got this great deal, right? And I would red eye out to Houston, and I would be walking units and slaving away, and the guy that lives in Dallas wouldn't show up. And so there's a huge dropout rate in this industry. And I've seen, if you're talking about partnering, what I've seen is that a lot of people are very busy professionals, and I had to rearrange my profession around being a contractor, and so that I had more freedom to be able to actually proceed and progress in this business until I left it. They truly are busy with other things. They actually can't devote the time if they're not full time. And a lot of other individuals just simply are already settled and happy with where they're at. They don't need to hustle, and they're not in a hardworking mentality. I've always been an extremely hard worker. I got from I mean, that's just me by nature. Not everybody's like that. What I found is if you talk to the gurus out there, is actually a 90% dropout rate from people that'll pay what are they, like 20, 40,000? Whitney, you probably know.
Yeah, it could be anywhere from 20 to 75,000. I've seen it all over the place.
Yeah. And there's like a 90% dropout rate. And it's not
for sure.
It's not the teacher, and when the student's ready, the teacher will appear, right? And so it's you that make it, and it's the individual, and it's their drive. So it also, in the crucible of getting work done, is how partnerships are interviewed in my mind. It's when the broker actually sends a deal. Is it underwritten and independently, or somebody waiting for somebody else to do it? And we come up with the right solutions and the same conclusions every time. And are we working? And do we show up? And is it actually happening? As so many different partnerships, they've been like, all right, let's partner with jobs you want to do, and what percentage do you want? And then they'll quabble and argue. And I'm like in these masterminds actually with these people, and they're saying that they can't get a partnership agreement signed. And I'm like, well, you don't have a deal. You guys haven't. And one of the interesting things is that in California, the average, where we're from, the average major change in a California state system is 3 times. So it's not, people don't go to college because they're like, I don't know what I want to do. Well, you won't know until you get in there and start doing it. And when you get in there, start doing it, you're going to think you know what you want to do, and it's going to change. And then you're going to think that's it, and then it's going to change. And you think that's it, and then it's going to change. It's really about getting in there and getting the work done. And what happens is people reveal themselves, and you're going to find people that you click with because they're the people right there working with you. And it's when those mindset and those mentalities of what their goals are, long-term, short-term, show up, and how they're underwriting, how they're analyzing, and what kind of investors they're bringing, you'll see a very clear overlap or gap. And it's just the key is just start doing the work, right? And get in front of people and start working with people, and then it'll happen. It's not the easy thing, because it just do the work is the response, kind of, and then people will gravitate to you, or you'll be pulled in like I was, because they just needed somebody that they could trust to get things done. All the things I thought I was going to be doing, that actually wasn't what they needed. They actually needed somebody that they could trust to figure things out and get it done, and they could rely on. And when we did one together, we essentially was addicted to me, because the next one we just did everything. I just did everything, and then I did more, and then the next one I just did everything and did more. And then it was just so natural. We didn't even have, we had kind of a loose handshake, but I didn't have an agreement until after the close of the second deal. But I was just excited to be in the game with the right people and doing the right kind of work that I believed in at that point. And that's how it was. Kind of potentially might seem backwards, but that's how it happened for me.
No, that's awesome. I agree. Getting in the trenches with others will tell you a lot. Right. Will tell you a lot. It's and I've had, we've done the same thing as far as flying places last minute, being there, for and it does, it shows you, who's committed, who's not. That's just one little example, but yeah, there's so many things that when you're shoulder to shoulder making it happen, you quickly see. Patrick, we're gonna end this segment here. I want the listeners to know, hey, we're gonna do another segment with Patrick, and we're gonna talk about leaning into this recession and finding the upside in the downside or downturn, finding a deal, what that looks like for Patrick today. Patrick, before we do that, tell the listeners how they can get in touch with you and learn more about you.
Yeah, sure. So I make an offer because I being the engineer, I keep my head close to the grinding wheel, and it wasn't natural to get my story out there. And when you was saying, I'm surprised I didn't hear about you earlier, it's because I didn't tell people I was out there. I'm not the big flashy marketing guy, but I actually got some advice. Again, I listened to advice to get my story out there, because I was a working professional like many of you, battling ups and downs. And so I collaborated on a book with some other really cool people like Phil Collins, lead guitarist of Def Leppard, actual rock star, NFL, NBA players and stuff. And it was persistence, pivots, and game changers, turning challenges into opportunities. And I'd be happy to gift your listeners a copy of that. I just bought a bunch of them. I think it's really cool and inspiring content. If you go to investonmainstreet.com/book, investonmainstreet.com/book, and then you put in the promo code, the name of this podcast, my team I'll sign it and we'll ship you a copy just to help inspire you along your way. And if you'd like to chat about investments, happy to do it. investonmainstreet.com/contact, or anywhere on the page. My calendar's there, and that's one of the beautiful things about doing what I do is I get the opportunity to talk to investors. I don't have a ton of availability, but I do have availability. So if you want to chat, be happy to get you pointed in the right direction. And my email's patrick@investonmain and then street, investonmain and then street.com. We have investments at the top of the page.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.